Okay, so today on this session, we're going to cover something that's been asked a lot, and there's no videos on this yet. I'm glad to kind of make one. It's over dynamic hedge pressures. Now, these indicators are not in Rocket Scooter platform yet. They are in the bot in the Discord that publish them daily. So if you go to our Discord right now, the various bot channels have different mechanisms to trigger them. 5:45-ish, 10-15 minutes for the Globex opens. We try to get them run. If you click this button, it will take you there, and the bot will spit these numbers out, and there's a little bit of instruction. Above S&P futures, Russell, NASDAQ, and VIX, we give these to you. And what it says is above high hedge pressure, the overnight, it's a bullish pivot. If we open above 4301, it's a bullish pivot. If we're below the low one, it's a bearish pivot. If you're in the middle, it's just bouncing between the two. And above or below the monthly hedge pressure number is an estimated bullish bearish sentiment, which we call bullish or bearish structure. So what we do with dynamic hedge pressure is really neat, but essentially what it is are pivots on your chart for the overnight. I've pre-drawn them before this video: high, a low, and then there's a yellow. Now we know the easiest one is monthly hedge pressure to understand. And what this is actually doing is estimating that if the deltas were held the same over the course of the night, it's an estimate that says if our price does not change at all overnight at exactly 9:30 in the morning, hedge pressure is going to be in between one of these two lines. So it's telling me that tomorrow I'm expecting hedge pressure to be here in this range. And monthly, we just give you an estimated of the monthly instead of the range, just to make it simpler to follow. If it's in the middle, if we open in the middle, then the market's likely going to pivot between the two. If we open above, it's just like being above hedge pressure, which you guys remember, it's long. Again, the estimate is based on the fact that price doesn't go anywhere. But of course, price always goes somewhere overnight. So hedge pressure will be somewhere else. But the idea is that in the overnight, this is the best we can analyze when our stock markets close and options won't be trading. So anything that opens above here, it's kind of like liquidity map gives you an L for being long, right? Above hedge pressure, we call it L for long. If we open down here, then it's considered S for short. If you open it here, it's neither long nor short. It usually bounces between the two. So above the highest high, we just say that it's like getting an L. Below the lowest low, it's like getting an S. It's an L, it's an S, an S, it's an L. And in the middle, it just kind of does that. The monthly estimate is to estimate up or down. If both hedge pressures are here and monthly is here, and we're up here, if hedge pressure can be anywhere, it's a U. We open up here, it's a potential long up tomorrow. Same thing here. If we open up here, it's a long up, or down here, it's a short down. So the idea is that when you have your liquidity map, we can even kind of estimate the effects of what long up and short down would look like. And it just kind of gives you that estimate of what to possibly expect tomorrow. In conjunction with the interval band, we give you risk interval band, which is another bot. Where this closes, there is an upper and lower rational band of what this bot will give you. And this, again, watch the doomsday video. We'll walk you through this. If we assume the market won't be irrational, because if we're opening inside the bands, we don't ever bet that we go outside the bands in the overnight. It can happen all the time. You know, it's very infrequent that it becomes irrational, but we don't bet on that. So the idea is that now I can formulate a little bit of trade plans in my futures trading. So if we open up here and it's a potential long up, then I can buy the open, buy the dip again, and stop right here to bet that it still stays long up for a trade right there. So now I have each one of my entry points here to here, here to here, here to here, with a reward and a risk for all of them. So the same thing if I want to bet on the short side, right? If the market gaps up here and I wanted to short this to fade it, possibly somewhere in here, there's going to be a wave of pressure against me. So I know my short really doesn't go too far from here, but I know if we somehow clobber through this, then the market's very short, but the exception of we don't bet it becomes irrational. So in this particular sense, there's really not much of a short trade even through here. If we wake up to down there, then I'm really not going to want to do anything. There's maybe a short to only there, and maybe to only there, and maybe I'll hold a little bit more to there, but I'd probably close at any one of those resistances because I still expect it to push higher. I invented this so that, say I was long the market, right, up until the end of the day, and I wanted to know where I put my stop losses when I go to sleep. An example, say that I bought SPY today to hold for the month, and SPY rallied. Yay, we're good. And right at the end of the day, even though I run these at 545 for the overnight bot, when Rocket Scooter has this in the platform, these numbers will be ticking live. So if 1 minute before the market closes, you'll know what the hedge pressure's estimate is supposed to be. So say that we close right there and I say, I need to get some puts, right? Just so I can go to bet on this position. Well, if I know that hedge pressure is likely there or there, wouldn't it make sense that I've got puts there or there as well? In the event that it does become bearish, I can sleep on that position while the market's crashing, and I got puts that I bought for the market close before I go to bed. But I know where I need to protect myself in case the market's falling. But say you had Apple into the end of the day, and now the S&P is starting to crash. Well, maybe I'll short some ES futures or NASDAQ futures at this point to go with that. Now, you're going to wake up and hedge pressure might be there. It might be there. And you might be like, well, I thought hedge pressure is supposed to be inside of here. You will notice that these two still pivot like hedge pressure was there. But depending on where our price ends up overnight, hedge pressure is going to be a reflection of that opening price, plus that opera data that actually gets released overnight. So we don't know what that is here. This is based on the estimated open interest model. This is based on the real open interest model. So hedge pressure will clearly move, as an estimate is only as good as being an estimate. But even the estimate itself are razor sharp pivots overnight. So the way that I look at it, just to repeat, at the end of the day, if I'm long or short the market, I know where I have my calls. Long the market, I know where I have my puts. If I'm trying to trade futures, I know I can long on a gap up and long at the dip and long right here and stop right there for a move maybe to doomsday. I know that overall, that possibly that this is likely a long up for tomorrow, which gives me a couple of options to think about in playbook just to get ahead. Bull long up, as you see, bounces on the hedge pressures. So bounces on the hedge pressures. Bear long up also bounces on hedge pressure. Clearly, the long ups like those kind of moves, right?